Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Yeah, thanks for having me. It's great to be here.
So I want to just take a quick second to look at the calendar. It's Monday, March 2, 2026. And if you are listening to this right now in the U.S., your news feed is probably, well, it's dominated by two things.
Right.
Whatever President Trump tweeted this morning and the ongoing chaos over the Middle East.
Which is completely understandable. I mean, those are the loudest stories in the room right now.
Exactly. But while everyone is, watching the front door, we are going to look at the back door. We're going to look at a very specific and honestly somewhat surprising victim of all this global chaos. Japan. Because looking at the data we have today, it really feels like Japan is acting as the canary in the coal mine for the rest of the global economy.
That is a very fair assessment. I mean, the U.S. economy has its own narrative right now, mostly focused on domestic growth and tariffs and things like that. But Japan is facing what really looks like a perfect storm.
A perfect storm.
Yeah, and I don't use that phrase lightly. Looking at recent analysis from major banks and shipping reports from just the last 48 hours, the picture that's emerging is not just about one bad economic quarter. It is a systemic squeeze.
A systemic squeeze.
Yeah.
Okay, so what is our mission for this deep dive today? Because usually when we talk about Japan, I feel like American listeners tend to just tune out unless they're actively trading currencies.
Sure.
So why should the average beginner in economics, why should you care about this today?
Because Japan is the pressure valve.
Oh.
Our mission today is to connect the dots between a ship stuck in the Strait of Hormuz and the interest rate on a mortgage in Ohio.
Wow, okay.
We are going to look at how physical logistical blockages are causing a currency crisis, how that triggers a political crisis, and then finally we're going to open a very scary door into something called private credit that might actually be lurking in your own retirement fund.
Okay, you definitely have my attention. From ships to mortgages, let's start with the immediate news then. Oil prices.
Yep.
I saw the ticker this morning. Prices jumped about 9 to 13% just between yesterday and today.
Massive spike.
Yeah, a massive spike. And my first thought was just, okay, regular old inflation, gas is going to cost more at the pump. Is it really that simple?
I really wish it were that simple. See, usually when oil prices go up, it's because demand is high. Everyone wants to drive, everyone's flying. Or supply is just being cut to squeeze prices higher.
Right.
But this is different. According to the research we've been analyzing, this shock is completely about logistics. It's physical.
Physical in what sense?
Yeah.
Like the oil actually physically can't move?
Exactly. We have to look at the Strait of Hormuz. It's this narrow waterway that handles roughly 20% of the entire world's seaborne crude oil.
20%.
Yeah. And the headlines might just say tensions are high, but the data tells a much scarier story regarding insurance.
Insurance? Wait, you mean like car insurance, but for giant oil tankers?
Basically, yeah. Every single ship needs war risk insurance to enter that zone. And recent reports indicate that insurers, the big firms in London and New York, they are pulling that coverage.
Wow.
Or they are pricing it so incredibly high that it just completely wipes out the profit margin for the entire voyage.
So it's not that the strait is literally blocked with like a giant chain link fence or military ships bumper to bumper. It's that the insurance companies have effectively put up a do not enter sign.
Precisely. Major shipping companies are extremely risk averse. They are absolutely not going to sail an uninsured billion-dollar vessel into a conflict zone.
Okay, let me try to visualize this for the listener with a really simple analogy. Let's say it's Friday night. You want to order a pizza.
Okay.
You have a coupon, you have cash, you are totally ready to buy.
Yeah.
But the delivery driver looks at the GPS and sees that the only road to your house has a massive pothole and reports of carjackings.
Right.
He just says, I'm not driving there.
That is the perfect analogy. It literally doesn't matter if you are willing to pay double for the pizza. If the driver won't drive, you don't eat.
The transaction fails.
It fails. Not because of the price tag, but because of access.
And for Japan, this isn't just about missing dinner.
Oh, no. This is existential for them. Japan imports over 90% of its crude oil from the Middle East.
90%.
Over 90%. Just let that number sink in.
That's not just a dependency, that is an umbilical cord.
It really is. As of today, March 2nd, the tracking data shows Japanese-bound tankers are literally just parking in the Persian Gulf. They are dropping anchor and waiting.
Just sitting there.
Just sitting. Major Japanese energy companies, places like Itochu and Ineos, they are scrambling right now. They're checking their reserves. But reserves only last so long.
Right.
The uncertainty of the supply chain is the immediate killer here, not just the price tag.
So, the ships are parked. The oil isn't arriving, but the Japanese economy still has to run. People still have to go to work.
This leads us to that term that economists seem to be throwing around lately, stagflation.
Yes.
I feel like I hear this word on the news all the time, but I'm never quite sure if they're using it correctly. What exactly is happening in Japan right now that fits this definition?
Well, stagflation is basically the absolute nightmare scenario for any central bank. It is the unholy marriage of two things that really shouldn't happen at the same time: stagnation and inflation.
Break that down for us.
So stagnation means the economy isn't growing, factories aren't producing more goods, companies aren't hiring new people, and inflation means prices are going up rapidly.
Okay.
So you have a situation where the overall economy is getting smaller or just flatlining, but the cost of living is getting much bigger.
That feels like it's like getting a pay cut at work exactly when your landlord decides to raise your rent.
That is exactly what if brutal.
It is. According to data from Morgan Stanley MUFG, a 10% rise in oil prices lowers Japan's real GDP by about 0.1%.
0.1%.
Mm.
I mean, that sounds like a tiny number. Why should anyone panic over a fraction of a decimal point?
Because Japan's economy is already incredibly fragile. They don't have 3 or 4% annual growth like the US sometimes does. They grow by inches.
Ah, I see.
So a 0.1% drop is actually a massive chunk of their total growth potential. And the Nomura Research Institute is even more pessimistic.
What are they saying?
Data indicates that if this Hormuz disruption continues, GDP drops 0.18% and inflation jumps 0.31%.
So they're actively losing growth and gaining inflation simultaneously.
Correct. And this really hurts regular people. Japan has been trying for literally decades to get wages to go up. They finally started to see some positive movement recently.
And now this.
Right, this energy shock just wipes that out entirely. If your paycheck goes up 2%, but your electric bill goes up 20%, you are objectively poorer than you were before.
So consumption people just going out and buying stuff,
Yeah.
it just dies.
It gets crushed, completely crushed by energy costs.
And usually when consumption dies, the government steps in, right? They pass a big stimulus bill, they send out checks to people. Why isn't that happening here?
Because the government has almost no room to fix this. They're handcuffed. And this brings us right to the political headache in Tokyo. We have to talk about Prime Minister Takashichi.
Right, she is relatively new in the grand scheme of things, and she came in with a lot of big promises about strengthening the economy.
She did. She promised to fight inflation and help everyday households. But look at her options today. On March 2nd, she ordered an estimation of the economic damage, and she started hinting at flexible measures.
Flexible measures. That sounds a lot like politician speak for printing money and handing out subsidies.
It usually is. It means the government pays part of the gas price so the consumer doesn't feel the pain at the pump. But here's the trap.
There's always a trap.
Always. To pay for those subsidies, the government has to borrow money. They have to issue more debt, Japanese government bonds or JGBs.
But isn't Japan already kind of drowning in debt?
Yes. They have the highest debt to GDP ratio in the developed world. The bond market is terrified of more spending.
Right.
Looking at the data from January and February when Takaichi just talked about her spending plans, the bond market threw a massive tantrum. Interest rates started pushing around.
So if she tries to help the people by subsidizing gas, she crashes the bond market. But if she doesn't help, the people basically starve because they can't afford energy.
Exactly. It's a lose-lose. And this creates a massive tension with the central bank, the Bank of Japan or BOJ. This is where the plot really thickens.
Ah, the classic battle, the politicians versus the bankers.
You got it. Prime Minister Takaichi wants to keep the party going. She wants cheap money to fund her spending and keep the economy limping along. In fact, she recently appointed a dove to the BOJ board.
A dove, meaning someone who prefers to keep interest rates low.
Exactly. But the BOJ is looking at that inflation number we discussed. They're seeing prices spiraling up because of the oil shock.
And the standard textbook response to inflation is to raise interest rates.
Right.
To cool the economy down.
Right. The BOJ is worried the house is on fire.
So the Prime Minister wants to keep the party going, but the central bank knows the house is on fire. They are pulling in completely opposite directions.
And that policy confusion makes global investors incredibly nervous. When investors get nervous, they sell that country's currency.
Which brings us perfectly to the Japanese yen. Now, I have always been told, literally since I started following finance, that the yen is a safe haven.
Right.
Like when there is a war, when the world gets scary, you buy the yen because it's a safety blanket.
That was the common wisdom. That was rule number one of global finance for 30 years. But according to the analysis we're seeing right now, that rule is breaking
Breaking.
completely. The market is proving it. When the Middle East news broke, the yen initially rose for a second, and then it just crashed right back down. It's hovering around 157 yen per dollar.
Why is that happening? Why isn't the safety blanket working anymore?
Because of the root cause of the crisis, energy. Japan has almost no domestic energy. They absolutely have to import it. And oil on the global market is priced in US dollars.
Ah, okay, I see where this is going.
To buy the expensive oil, Japanese companies have to sell their yen and buy dollars. It is a mechanical, forced transaction.
So if oil gets more expensive, Japan just has to sell more and more yen to get the dollars they need to pay for it.
Yes. They are flooding the market with yen just to keep the lights on. That lowers its value. It's an identity crisis for the currency.
It's a doom loop. And the central bank, the BOJ, is just caught in the middle.
It is a total nightmare for them. They have two options, and they're both terrible.
Let's hear option A.
Option A is they raise interest rates to save the yen and try to stop inflation.
But the risk there is that it kills the economy, right?
Ooh.
Makes borrowing too expensive and stops growth.
Exactly. It crushes what little growth they have. Then you have option B,
Which is keep rates low.
keep rates low to help growth. But the risk there is inflation gets much worse and the yen crashes even further.
So they are totally trapped.
The BOJ meetings coming up in March and April are incredibly complicated. They are behind the curve right now, reacting too late to a problem that's moving way too fast.
Okay, so we have a physical shipping blockage, a stagflation trap, a political feud over subsidies, and a currency crash. I feel like that is enough disaster for one deep dive, but looking at the outline, there is something else lurking in the shadows here.
Yes, there is a hidden financial risk.
You called it private credit, which sounds very exclusive, like a black credit card you have to be invited to hold. But I have a feeling it is something much riskier.
Much riskier. Think of it as shadow banking.
Shadow banking. Explain that for the beginner.
Okay, in the normal world, if a company wants a loan, they go to a traditional bank, right? There are heavy regulations, lots of transparency, everyone can see the terms. Private credit is different.
Oh, so?
It's like lending money to a friend based on a handshake rather than going through a bank. It is highly flexible, which companies love, but if that friend loses their job, you are in serious trouble because there's no safety net.
Less regulation, less transparency. But what is the global context here? Why are we talking about this today?
Because looking at recent data, U.S. firms, massive private credit firms like Blue Owl, they are facing severe liquidity stress. And in the UK, a firm called MFS actually collapsed recently, which really scared the market.
Okay, so these handshake loans are starting to go bad in the U.S. and the U.K.
Yeah.
But what is Japan's connection to all of this?
We have to look at Norinchukin Bank.
Norinchukin. That is the massive Japanese agricultural bank, right?
Yes. They take deposits from Japanese farmers and they invest them. But because interest rates in Japan were at zero for so long, they couldn't make any money keeping that cash at home.
So they had to go hunting for higher returns overseas.
Exactly. They looked at the U.S., and they invested heavily in bundles of these private credit loans, things called CLOs.
Let's pause there. CLOs. We definitely need a simple analogy for that because it sounds very complicated.
Think of a CLO like a sausage.
A sausage. Okay.
You take a bunch of different loans. Some are given to really solid, good companies. Some are given to really shaky companies that might go bust. You throw all of those loans into a meat grinder, mix them up, and package them into slices.
So the idea is that even if a few of the bad loans go sour, the whole sausage is still theoretically edible.
Exactly. And Norinchukin bought billions of dollars worth of this sausage because it paid a high interest rate. They've actually been warning about volatility in these markets since 2025.
Because the shaky companies in the U.S. are starting to default on those loans.
Right. High interest rates in the U.S. have crushed those borrowers. So the Japanese banks are dealing with massive losses on their foreign private credit loans. But here is the double whammy.
Oh boy, the double whammy.
Simultaneously, rising interest rates back home in Japan are hurting the value of the safe Japanese government bonds they also hold.
So they are losing money on their risky bets abroad and losing money on their safe bets at home.
Precisely. It is a credit stress plus rate volatility combo. It makes Japanese banks incredibly risky right now.
And this is where the whole story connects right back to our listener in the U.S.
Yeah.
Because I can hear someone sitting in their car in Chicago saying, well, that really sucks for the Japanese banks, but why do I care about their bad investments?
You care because of what those Japanese banks might have to do to save themselves.
Which is what?
They need cash to cover those losses. Japan is the largest foreign holder of U.S. government debt.
Wow.
Yes, they own over $1 trillion of U.S. treasuries.
I see the dominoes lining up now.
If the yen hits 160, or if these private credit markets crack further, we might see a financial crisis that starts in Japan but absolutely does not stay there.
Because if Japan needs cash, they have to pull back. They have to start selling those U.S. treasuries.
And when you flood the market with U.S. treasuries, the price goes down and the interest rate goes up.
And U.S. mortgage rates are directly tied to the 10-year treasury yield.
Bingo. A financial crisis that starts with a physical shipping blockage in the Persian Gulf, moves through a farmer's bank in Tokyo, and ends up directly spiking your mortgage rate in Ohio.
That is a terrifyingly clear line of dominoes.
It is. The global economy is completely wired together. You just cannot isolate these risks anymore.
Okay, we have covered a huge amount of ground today.
Yeah.
We went from the Strait of Hormuz to the confusing world of CLOs and sausages. If the listener takes away just 3 key things from this deep dive, what should they be?
Number 1 is logistics. Watch the ships and the insurance at Hormuz, not just the oil price ticker. If the ships can't get insurance, the supply stops. It's the empty shelf problem.
Right. Watch the delivery driver, not the coupon.
Exactly. Number 2 is currency. The yen is rocked because Japan is energy starved. As long as they need to sell yen to buy expensive oil, the currency is going to suffer.
And number 3?
The investment view. Don't look at Japanese stocks, bonds, or currency in isolation. They are all reacting to this oil shock together. And don't think your U.S. portfolio is immune.
Because of the private credit connection.
Right. If Japan has to sell U.S. debt to cover their losses, it affects us here at home. How does the U.S. respond if its biggest foreign creditor has to pull back cash? That's the question we need to be asking.
It's a incredibly sobering thought. We often just look at the U.S. stock market hitting highs and think everything is fine. But looking into the hood at Japan, the engine is making some very strange noises.
It definitely is. And ignoring those noises right now is the most dangerous thing you can do.
Well, on that cheerful note, we are going to wrap it up for today. We hope this deep dive helped you see the bigger picture beyond just the daily headlines. We will definitely be keeping a close eye on the yen and those parked tankers in the Gulf.
Absolutely. It's going to be a critical week to watch.
Thank you all for listening. Don't forget to subscribe and hit that like button.